The end of financial year has arrived. Can you believe we are already over 6 months into 2025, which means we need to go back and do our tax returns. Now, I am someone who's probably a little bit on the slow side as a business owner, and even with my personal tax returns and actually getting these things done. And that might surprise you because when you're a business owner, you might be able to delay your tax returns a little bit. And I've done that in the past. But we're getting on top of things now. And so in this video, we're going to be breaking down 7 tax tips for FY25, and I'm even going to be sharing with you at the end of this video a tax template to help you break down your own personal taxes and your property investments and other deductions so you can map it out and provide this spreadsheet to your accountant to give you a head start on tax time and so that you truly understand your own numbers. My name's Luke and I talk all things real estate, renovating and financial freedom here on the channel. If you are interested in working with myself and the team to buy your next property here in Southeast Queensland, then head over to purposeproperty.com.au. So I'm not going to delay. Let's dive into these tax tips. I've even prepared on Canva some decent looking slides. I know Emily would be proud of this and how it looks. So let's jump into tax tip number 1. So number 1 is making sure you claim all of your deductions. Now, as a property investor myself, there are so many deductions that you can claim. Advertising, strata, rates, water, land tax, cleaning, pest control insurance, interest, expenses, property management fees, some repairs and maintenance, legal fees, bank fees, the list goes on. There are so many expenses. Now, the way I like to track all of these deductions is to have a bank account for each of my investment properties. And what this allows me to do is look at the ins and the outs of my own property investment portfolio at an asset level. So if, one house, Bray Park, for example, on the north side has its own bank account, all the ins and outs for that property go through that bank account. So when I get my summary from my property manager for those fees and expenses related to the financial year, plus any other fees and expenses, I can amalgamate that information and make sure I put that all into my spreadsheet to track the actual deductions for the financial year. So that's exactly how I do it, and making sure that I'm claiming all the immediate tax deductions relative to my investment property and my personal and business life as well. Number 2 is negative gearing. And so all negative gearing is a tax outcome. So when your expenses exceed the rental income on a property, so you might gain $25,000 of rental income in the year and you might have $30,000 worth of expenses. And so what that means is you're going to be able to negatively gear by $5,000, which is the loss of the income relative to your expenses on that investment property. And so if you're earning $100,000 a year, your taxable income will drop from $100,000 of taxable income to $95,000. What this means is you're reducing the tax you pay. So if you're paying in that tax bracket, say 30 cents in the dollar, you're not gaining a $5,000 benefit. You're gaining 30% of $5,000 as the financial benefit based on that negative gearing outcome. Now, I wouldn't go make my investment decisions on this basis based on negative gearing. It's just a tax outcome, but you still need to understand your numbers to make sure you can cash flow any investment properties that are negatively geared. Number 3 is timing the sale of CGT assets. This relates to any assets that attribute CGT or capital gains tax. So this example on screen is a property that Emily and I bought and sold. So we bought in 2020 for $544,000 and we sold in April 2024 for $963,000. And I broke down based on the ATO's website, the cost base, the additional costs, the sale price, or they call it the proceeds, is what the ATO calls it, to calculate the capital gains tax. Now, while the timing is so important, is because this ends up, there's no such thing as a separate capital gains tax here in Australia. All that happens is that gain, say we made a $300,000 gain in this example, that gain ends up going into your personal tax return, and that's why timing the sale is very important. So if you have a wife and she's going on maternity leave and she owns this investment property in her name, that could be a really opportune time to sell that asset. You also need to take into account these 2 things in the top right corner of this slide, which is the 50% CGT discount. And so if you hold that asset over a year, you actually reduce that gain by 50% for the taxable purposes. And so let's say we made that $300,000 gain. The actual amount you need to put in your tax return is only $150,000. And if you own that property in 2 personal names, say Luke and Emily in this example for 25 Leach Street in Everton Park, we split that $150,000 by each of us. So $75,000 went into my tax return and $75,000 went into Emily's tax return. Now, if you're a business owner, you might not need to be on maternity leave or not working. You could just reduce your personal income in that financial year to give yourself a better looking tax return. And that's all completely legal. And that's the flexibility that business owners get. So point number 3 is time your CGT sales. I'm certainly not an investor who says hold everything forever. There is purpose in selling property investments, and we certainly did that with 25 Leach Street in Everton Park. So take that into account as tip number 3. Tip number 4 is something I'm planning on personally using in the next few years moving forward. Given that I'm going to be moving out of the raise and build project that we did in Greenslopes, I'm going to be renting on the south side of Brisbane, and I'm going to be putting into play the 6-year rule. And what that means is this only really works for rent vesting. So people who own their own home and then end up moving out of their own home and renting elsewhere. And so the property was your main residence. You treat it as your main residence for capital gains tax purposes for up to 6 years, and you can rent elsewhere during this window. And so I move out of Greenslopes and maybe I sell this property after 3 years while renting elsewhere. I can still claim the sale of this property in Greenslopes as a capital gains tax exempt asset as my own home. Now, the cool thing is you can do this up to 6 years, but you can also reset the clock. So say after 3 years, I decide I want to move back in for a year. So I move back to Greenslopes for a year, and then I move back out. I maybe go live on the Gold Coast or on the south side of Brisbane in another location. I can start that 6-year rule again. Now, the reason the ATO brought this into play is there are lots of people who have to move for work or for family circumstances or for various reasons, and they don't want to penalise people who are forced to move from their own home. And say you got a job offer in Melbourne or Sydney, and you take that job offer, but you can't afford to break into that market or you want to rent in that market. That's one of the reasons they brought this 6-year rule in. And so everyone's only allowed one main residence exemption. Now, there is a thing here where the wealthy will buy very expensive assets and get those capital gains tax free. So if I bought a $10 million house and I was able to then go rent a $1 million house, I can technically claim that $10 million house as tax-free for up to 6 years in terms of any gains that that property makes. And so there are people who play these rules and use them to their advantage, and those are the rules we play by. So tax tip number 4 is understand the 6-year CGT rule and how it works with the main residence exemption. Tip number 5 is to maximize depreciation on your investment assets. Now, when it comes to property, depreciation is what's known as a non-cash deduction. What a non-cash deduction is it means you haven't actually forked out any cash to claim that tax deduction. And so the way that works is, say I'm able to claim $5,000 worth of depreciation on my unit block in Coffs Harbour, for example. I haven't actually forked out an extra $5,000 to claim that expense, but I can claim it because the building has devalued by $5,000 in that given year based on a quantity surveyor's assessment. And so land appreciates and buildings depreciate over time. And what a depreciation schedule allows you to do is claim the fall in value of the building. The two methods of depreciation are called the diminishing value method or the straight line method. Generally, most property investors will go for the diminishing value method because it gives you greater depreciation deductions in earlier years and lesser in the later years of that schedule. And that's what I've done for my investment properties. And so the one thing you have to take into account is the impact. This second point down here is the impact on the sale of your property because it lowers your cost base even further, meaning that you're going to have more capital gains tax. So say I bought a property for $500,000 and sold it for $1 million. If I claimed depreciation for $5,000 a year over 5 years, so $25,000 in total, using the straight line method, then my cost base would drop from $500,000 to $475,000. So that's something you really need to be wary of, is that yes, it's going to give you a benefit in each financial year for your tax returns, but when it comes to selling that asset, it does impact the cost base of the sale, impacting your capital gains tax calculations. And that's why we've got these 2 points on screen here, which is it improves your year-to-year cash flow, which is the tax incentive. And this is why we do it, because we want to improve our tax and cash flows now, but it is going to impact you at a later date when you sell that asset. This leads me into number 6, which is the structuring for tax purposes. Now, the two on screen here is we've got family trusts and personal names. There are other ways you can buy property. There are different types of trusts. A family trust generally refers to a discretionary trust, which is the most popular type of trust and the ones that I use. But other investors like Jack Henderson and other people out there use unit trusts for different reasons, and then a discretionary trust, which is a bit more complex. And then other people again use companies because they're developing, and there can be different strategies to buying directly with a company. But that's going to impact your capital gains tax. The simple, the cheap, the easier lending option is the personal names. Now, generally, for my approach personally, and with a lot of our clients in the buyer's agency at Purpose Property, we help clients form a strategic approach. I'm a chartered accountant by trade and have been running this buyer's agency coming up to 5 years. And so the view for me in terms of building out a portfolio is to generally begin with personal names first and then transition into family and trust structures as you get more advanced. Now, one of the things a lot of people have talked about with this infinite trust structure lending is that, you need to jump straight into the trust structures to get the benefits of that lending. But there's so much nuance to that. You actually need to be wary of negative gearing, because if you buy in the trust structure and you're negatively geared, you're going to hurt your borrowing capacity. So you might be able to borrow $700K in your personal name, but only $550K because of the negative gearing impacts in the trust structure. Now, there's creative ways. I've heard lots of different creative ways that people can say that their trusts are washing their face or neutrally or positively geared, but just be very wary of all those things. For me, simplicity is key. Generally, I've started personal names first and then got into trust structures as I've become more advanced. And I have multiple properties and trust structures at this point. And I'm looking to do those development sites that we've been speaking about on the YouTube channel. So take a look at your own ownership structures and the complexity and the pros and cons, and work out what's best for you when it comes to tax time and building out your property portfolio. Number 7 is good record keeping. So that comes back to my earlier point about having a bank account for each investment property, as well as what we're going to dive into right now, which is the tax template to round out this video. And I'll share with you how you can get access to the link below. But to get access to this tax template for free, you need to do something for me, which is drop a like on this video and subscribe to the channel down below. It helps me out a ton, and hopefully you guys get help out of this tax template as well. So let's dive into that now. So on screen, we have the tax template. This isn't crazy advanced. This isn't rocket science. And so hopefully this just gives you an idea of how I simply lay out my tax returns for my accountant, which I don't do my tax returns myself because you'd be crazy to do your own tax returns. When the ATO comes knocking, I want them to go to Derek and knock on Derek's door, not come knocking on my door. So even as a chartered accountant, I still have another accountant double check my work. But this is going to save you time and money and give you the knowledge of where your taxes are. And so this is how I prepare my own returns. What you've got at the top here is any salaries and wages. We've got a column for the annual or total. Then we've got a column for each individual in a household. So this might be you and your wife, or the wife and husband, that scenario where you've got two people and you're preparing the tax returns. And this is very common for property investors. Say you and your brother are investing, then it might be sensible to lay out a tax returns like this so you have a clear view of how you're splitting the property income and expenses. In this first section, we've got the wages, so you can put in bonuses, allowances, tips, all those types of things. You've got your gross income and the tax withheld. So when you get your, what they call activity statement, I believe, or income statement, they change the names. When you've got your income statement, which you can get on your MyGov portal, it'll show you your slip. So you'll show your employer. So you have a second job, you might have a second, this person has 2 jobs. They earn very little at one and a lot at the other. But you can change these numbers up. You could put $15,000 in, you might have no tax withheld. Or you might have, $5,000 of tax withheld. And the other job you might earn $70,000 and have $18,500 of tax withheld, not $185,000. It's too much money. So punch in your income and your pay as you go, and that will give you your first section filled out. You then might have interest. So CBA, you might have a long-term savings account. I know a lot of people with the ING high interest savings accounts. So you can put in your interests and you can put in dividends and any other income that you're earning. We then come to the property section. So this is how I track my property in these key categories. So we've got income, rental management and expenses and repairs are grouped, and I'll explain why in a minute. Insurance, water, rates, interest expense, which is going to be your biggest expense, and then depreciation, which is that non-cash deduction. In this example investment property, it earned $29,290. The rental management and expenses and repairs were grouped because this is the summary that my property manager would have provided. So your property manager should give you a summary or a statement that summarizes all the income and the expenses for the financial year on your said investment property. And so those first two numbers should really come from the property manager. The rest generally come from my own sources. And so I'm checking with Budget Direct or NRMA for insurance and, urban utilities for water and Brisbane City Council, and rates with Brisbane City in this example. Interest could be with CBA, and so I just draw an interest summary for the financial year and double check all these numbers. And the depreciation comes from a quantity surveyor who's prepared that diminishing value or straight line method report for this example property. Now, in this case, you can see here, this property is owned in personal names with a 50-50 split. And so you can split it 50-50. But if you owned it in 75-25, you can split it based on that ratio. So you can times this by 0.75 and times this by 0.25. The other option here is if you've got a trust scenario, you could potentially look at distributing the outcome of the trust. Now, losses are generally housed in the trust, so that wouldn't work in this case. But let's say that the property earned $50,000. Then it's $10,000 positively geared. You can actually distribute that difference. You might be able to put all of that into one person's tax return and balance out your scenario between a couple. And so that's where trusts are super powerful, giving your flexible distribution or discretion your family trusts. You can then send to the lower income earner all of that positively geared income. So that's just something to think about between personal names and trust structures. Generally, I want to buy my properties that are negatively geared in personal names, and I want to buy my positively geared properties with houses and 2 dwellings on them in trust structures. Or that allows us flexibility. And so if you've got the personal names and negatively gearing, you're getting all the benefits there. And then you've got your house and granny flat in the trust structure and it's positively geared, you can send the income more efficiently across your family. So to quickly round out the rest of this template, you've got other expenses, CAA and Z membership in my example, work from home deductions, other tax deductions that you want to put in there, any donations you might have made, and you end up with these numbers at the bottom. So what it spits out at the bottom here is the pay-as-you-go paid to date for the financial year and the total taxable income for that given year as well. You can then put that $95,086 into a pay calculator, and that will spit out the actual pay-as-you-go that you should have paid, and say that's $23,000, you get a refund of $2,000 in that example because you've paid more tax than you should have. Say that number is the inverse, then you will be able to work out if you owe the ATO some money. And so this is exactly how I lay out my tax template for my own calculations. And if you'd like to get your hands on this tax template, you can go into the description down below. If you just click show more, it'll be the next line under the description. And so download this tax template for yourself. I hope it's useful. I can't believe we are in a new financial year, FY26. Crazy to say. If you want to work with myself and the team at Purpose Property to help you buy your next asset here in Southeast Queensland, then head over to purposeproperty.com.au and I'll see you in the next video. Peace.